Hello, I'd like to thank you for joining us for this June 2013 economic update from Karsten Advisors. This is Tom Karsten, and the contents of this presentation are not intended as a recommendation to buy or sell any security, so I have to get that disclosure out of the way first. This is for our clients to discuss some of the recent market changes over the last part of May and mid part of June, and kind of set our strategy for what's going forward. So this is an article from Monday of this week, June 24th, from the Wall Street Journal. Markets have little faith, less hope, and no clarity for the Fed. And I think that's a very good example and description of what we've seen take place over the past couple of months. The Fed has come out with what is not the clearest of instructions, and it's left a lot of people wondering when and how they are going to be pulling back on the stimulus that has been pouring into the U.S. economy for the past year. So this is a chart on the yield of the U.S. Treasury. So this is talking about what is the percentage rate or the yield that is paid on a 10-year Treasury. And what's occurred is that it has gone up dramatically just in the course of 5 days. So it's been a very fast and dramatic move. Now you look at 2.2 and a move to 2.6, and you would think that that does not sound too dramatic. It's only still at 2.6% for 10 years. However, it does represent close to a 20% rise in the Treasury rates over that period of time. Now, what we've been seeing for the past couple of years is an environment where when interest rates fall, as they have been for several years now, bond prices go up. So it's been a ever-lifting tide for bond prices over the last few years. Of course, when interest rates go up, bond prices go down, and that's what we're seeing now over the past 5 days in a very dramatic fashion. So back to that, if we've got an increase in the 10-year Treasury yields, it's going to cause the price of the bonds to go down. So again, on the previous slide, you see rates going up, therefore the price of the bonds will go down. And this is the 10-year, the 30-year Treasury over the past 5 days. So you can see how dramatically it has pulled back. It's lost about 5% just in the last 5 days. And this is in an instrument that is considered the benchmark of safety, U.S. Treasury bonds. So typically in a portfolio you would invest in stocks and bonds so that you've got some diversification. If stocks are on the rise and bond prices are falling, you'd have some diversification, but not this time. What we've seen really over the last 5 days is all asset categories have lost value. It was very reminiscent of me to a little bit of the 2008 period where all asset classes just declined very dramatically. So what you see here in green is the USO. It's an index that tracks U.S. oil futures. GLD, which is an ETF that follows the price of gold, the price of the 30-year Treasury in red, and then of course the S&P 500 in blue. So we continue to see this trend over the last 5 days. Now, yesterday on the 25th, we saw a little bit of a rise in the markets, and I think that will likely stabilize for right now, but the big question is where do rates go in the future? So that of course leaves us with the question, what's next, and what do we do about it? So that's where we will focus the rest of our time here. This is a picture of Norman Schwarzkopf. He was the commander of Allied forces in the first Desert Storm War against Iraq. And I had the opportunity to read his book that he wrote after commanding our troops over there. And unfortunately he did just pass away in late December last year. But he had made a point in his book that when you're in leadership, you do need to take charge and you need to take action. The worst thing that you can do in battle is to not do anything at all. And here's a quote from his book. When placed in command, take charge. Even if the decision is bad, you have set change in motion. It's better than being stagnant. So that's a little bit of the philosophy that I have learned from that book. Now, I don't mean to compare combat of our troops with the market, but we do want to be mindful that it's always important to have contingency plans, reduce risk, take things in action. And so we've been very active over the last couple of weeks. And so our decisions have been to reduce risk. So we sold some positions with the greatest exposure to further increases in interest rates. We did not sell everything, but we have sold positions that we thought have the greatest exposure and would do worse in a rising interest rate environment. We continue to look for opportunities. Throughout the course of the spring, we raised cash positions by selling a lot of the equity investments in the portfolio, and now we're using that cash to go back into opportunities that we think are attractive, like Apple, Royal Dutch Shell, GE, and Saratoga. Those are positions that are held in most client portfolios. And then we have hedged potential risk by buying the TTT, which is an ETF that is the inverse of Treasury. So if Treasury prices continue to go down, as we have seen them, that will go up. Now, we do think that is a short-term position in the portfolio, but it does hedge or offset some of that future interest rate risk if that continues. So again, if interest rates continue to go up, bond prices will go down, and that is why we invested in that triple T. Now, one of the other investments we made, of course, everybody's pretty familiar, I would assume, with Apple, Shell, Oil, and GE, kind of household names. But Saratoga is a much smaller company. It's a business development company. And we purchased their notes, or fixed income instruments, at $25 a share, or per note, several weeks ago. It pays a 7.5% rate, and it's a 7-year note with the first 3 years non-callable, which means that they will have the note payable for at least 3 years. After that time, they could pay it off, returning the principal to clients. One of the best aspects is its daily liquidity on the New York Stock Exchange. And I personally met with the CEO when I was in New York on a business trip approximately a month ago. So they have held up very well over the last couple of weeks. In fact, they closed yesterday on the 25th at $25.01 per note. So they're actually up 1 penny since purchase. So we feel good about that purchase, and we will continue to look for opportunities there as well. On the Pro Shares, the ultra short 20-year Treasury I mentioned, this is the triple T, the TTT. We bought it at $86.85 a share, and it closed yesterday on Tuesday the 25th at $90.04. So it's up pretty dramatically over that period. So that has hedged a good bit of our risk. So we're pleased with that position where we are right now. So kind of shifting gears on what we expect for the remainder of the year or the future. If you look at the pending home sales index, the Case-Shiller and the new home sales figures came out yesterday, and continued improvement in the housing market. But if you look at this trend over the last few years from 2010 through 2013, you'll notice that we're still right about where we were in the wake of 9/11. And if we look at new home sales, we're still very far off of where we were at in January of 2000, and certainly nothing near the peak of the market in 2006 or 7. So still a long way to go, really, in that respect for the housing market, although it has been recovering. Now, raising interest rates is going to curtail that. So in my mind, I kind of question some of the moves, the Fed and government here recently, but they do need to rein in all of the spending as well. So it's probably a good long-term move, but in the short term here, it is, of course, causing a lot of volatility in the fixed income market. So I think Bernanke is right with his comments. Things are getting better. The U.S. economy is finishing its fourth year of expanding, so we had an average growth rate of 2.14%. That's not great. Unemployment has fallen by 1.5%, but we're still at what we would consider a relatively high figure of 6.5%. And our per capita GDP is number one among the largest 30 nations. So we are a very productive nation, and there's a lot of bright spots there. And it is growing momentum. So the growth in the second quarter is coming in at 2%. We could have some better figures in the second half, but again, rising interest rates are going to make it more difficult for companies to finance their operations. Consumers are holding steady because employment is improving, income is improving, residential real estate is up, and corporations are profitable. And certainly here in our section of the country, in Texas, we know that the energy sector continues to boom with a lot of build out in infrastructure. And we think that the banking sector fundamentals will continue to improve because banks do benefit from higher interest rates. They can charge more on the loans, so it gives reason to them to raise interest rates on the loans that they issue, but they don't necessarily need to have the rates they pay on deposit accounts go up the same rate, so that improves their margins in that kind of environment. But everything's not fine. We have not had a true recovery in a classic sense of the word. It's been a very slow and meager growth. And unwinding all of this stimulus, keep in mind it's $85 billion per month that the Fed has been injecting into the economy with their bond purchases. And it's still difficult to get the kind of credit that many homeowners want, many home builders want, and non-residential investment is lagging residential. So that's just here at home, and of course overseas, China has had some figures that have indicated they're going to have a reduced GDP, reduced output, and Europe is still in a recession, although I do think that they may be coming to the end of that. And then we've got some big short-term risk. The politics, debt ceiling, federal spending, it's a daily soap opera, it seems, with our leadership, and we really need to get our house in order in that respect. And again, Europe and China will continue to have issues, and the psychology of investors and what the Fed does clearly over the last 5 days has caused a great deal of volatility. So what is our strategy going forward? Well, we feel it's important to stay diversified, so we're buying not only stock positions but bond positions. We have been active buying and selling, so again, removing areas we think have some exposure, but also taking advantage of the pullback in stocks and bonds to add to some positions. And we'll take advantage of those opportunities, whether it's in the companies I mentioned like Apple, Shell, GE, smaller cap companies like Saratoga. And we need to recognize the risk, and we're going to reduce that risk, hedge against it, and be very active moving forward. And that's our most important aspect, we believe, is to continue to take action. So that represents the entirety of my presentation. I hope that it gave you a broad overview of the actions we're taking on your behalf in our advisory accounts. In the annuity accounts, those are actively rebalanced as well on a quarterly basis. And many of the annuities that you own, if you do own any of the annuities through MetLife or Hancock or some of our other partners, do have fixed guarantees associated with them, living guarantees on the annuities. But that, of course, leads to what is the specific breakdown of your portfolio and how it's allocated. If you've got questions about that or would like to discuss it, please feel free to give us a call, and myself, Jeff, or Marcus would love to get together with you and discuss that. With that said, I hope you have a great day. We've got the Independence Day holiday coming up, and I hope you enjoy that with family and friends, and we look forward to serving you through the remainder of the year. Thank you very much, and have a great day.